Welcome to Taking Stock for the week ending the 21st of October 2022. I'm Trinh, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented today shouldn't be relied upon as a guide for future performance. Well, Matt, we are currently going through a mini reporting season with our AGM season, and so far the earnings outlook remains quite resilient despite market concerns of slower economic growth. So, Matt, what are your observations on the market so far?
Yeah, it's an interesting question, isn't it, Kien? And a lot of moving parts at the moment. But my attention is very much with the US markets at the moment, and they tend to be a useful barometer of what we can expect here in Australia. And obviously, the third quarter reporting period is underway. And once again, a fairly familiar trend is being observed from my perspective, at least. And that is that operating results of corporate America look pretty good. They're not nearly matching the fear we're witnessing in markets at the moment. But I'll caveat that with the fact that we're only very, very early on into the reporting period. But to date, about 70% of companies have either met or beat market expectations. And most notably, or the most notable result of this week to date for me was Netflix, which easily beat expectations. And I think it left a bit of egg on the faces of the many, many detractors who had declared the business to be ex-growth. The company actually added 2.4 million subscribers worldwide over the quarter and guided for an even larger jump in net subscription growth into the fourth quarter. And some potential bellwethers for our Aussie banks that are due to release their own results in the next couple of weeks. Their US counterparts, such as Bank of America and JP Morgan, produced pretty stellar results late last week. The banks have reported a jump in their net interest margins, which on a simplified perspective is the difference between their lending rates and their deposit rates. And this is consistent with the theme that we observed with Star Income Stock Bank of Queensland when they released their results last week. And as long as the bad debts remain under control, then our major banks should continue to sustain their dividend yields of about 6 to 8% in the upcoming weeks. So we are in the midst of the bank reporting season, and many are expected to go ex-dividend around mid-November. Now, as depicted on the chart on screen here, expectations for earnings growth in the black line for the S&P 500 companies have been revised down for the next 12 months. And they've come down from 3% from the 4.5% that was expected just a month ago. So analysts are starting to pare back their expectations just a tad. But you can see here in the blue line that prices have been far more sensitive to the economic uncertainty than earnings, which always could present as an opportunity for investors.
Yeah, so hopefully earnings will continue to remain resilient over the next few months. But of course, we need to keep tabs on the active risks of rising interest rates and also inflation, because as mentioned last week, there's usually a 6-month lag between interest rate rises and the impact to consumers and businesses as well. But the AGM season here in Australia has also been promising, with star stocks outside of resources such as CSL, Brambles, APA Group and Perpetual all reconfirming their guidance. We also saw star growth stock James Hardie downgrade guidance, but that was only by about 3%. And the revised outlook was in line with consensus estimates anyway. So the chart on screen now compares the All Ords Index to the trend in earnings estimates. The trend in earnings for the entire market in the black line have been quite resilient. And this is due mostly to the bank sector, which have been supported by the rising interest rate cycle.
And on that look-ahead basis, Kien, the earnings growth outlook for the year is expected to be flat, mainly weighed down by the negative earnings growth from the resources sector as companies start cycling the strong numbers they produced last year in that soaring commodity price environment. This can be seen from the chart on screen, which compares the earnings growth rates for each financial year, separated into high-level sectors. The banks are expected to post single-digit earnings growth this year. And interestingly, earnings growth within the industrial companies are expected to accelerate, possibly as supply chain issues and inflationary pressures resolve themselves.
Yes, that makes sense. And earnings growth across our star growth stocks are also expected to remain in double digits for the year ahead. But turning our attention now to some star stock highlights for the week. Global pallet provider and borderline star growth stock Brambles, they expect growth rates to slow after December as cost of living pressures start to affect consumer behavior. However, its revenues remain resilient, with Brambles able to pass on in full the rising costs to timber, fuel, and labour. As such, management left financial year 23 guidance unchanged, with double-digit earnings and sales growth expected this year.
And across to the energy space, and again, a bit disappointing, Beach Energy reported an 8% decline in oil and gas production over the first quarter, due entirely to flooding at its Cooper Basin asset, resulting in unplanned outages. This has unfortunately resulted in a slight downgrade to their earnings forecasts, although the company said it has kept its full-year production target intact. In contrast, Borderline Star Growth Stock and Star Income Stock, Woodside Energy, and Borderline Star Growth Stock Santos reported production increases. And coupled with elevated energy price environment that we're currently experiencing, this should support its performance over the next few months.
And meanwhile, also in the M&A space, payments business Tyro, they've received interest from Star Income Stock Westpac for potential takeover. Now, Tyro is a mobile payments platform, and the deal would help Westpac gain customers and also data intelligence, so it could expand its business banking. But a few investors might be concerned about its distressed financial health rating and also how this could impact Westpac's overall business. And furthermore, this deal could potentially lead to customer losses for Tyro because its existing relationship with Bendigo Bank, which accounts for about 15% of transaction volumes, could be at risk.
Yeah, but Tyro has a market cap of only 800 million, which is about 1% of Westpac's market capital. So hence a potential deal would only represent a very small dilution to the bank's business and is unlikely to impact its financial health or dividend payments. Currently, we're expecting a gross dividend yield of about 7.4%.
Yes, it looks like the banks are doing quite well at the moment. But turning our attention now to the corporate calendar, Borderline Star Growth Stock and Star Income Stock, ANZ, they are expected to report on the 27th of October, followed by Star Growth Stock and Star Income Stock Macquarie Group the next day. Meanwhile, some interesting AGMs to be released include Credit Corp, Woolworths, JB Hi-Fi, South32, and Macmillan Shakespeare. And also for income investors, Macmillan Shakespeare and also Bank of Queensland are expected to go ex-dividend next week as well. For Under the Microscope this week, we take a look at Megaport. That's with the code MP1. The company helps businesses connect between data centers and cloud environments, and that's to eliminate the use of the public internet. And this enables for more reliable and secure internet connection.
Okay, it sounds like an interesting thesis, and it's appealing as a business because it has the potential to be a real disruptor, I think, to other data-driven companies, including telcos. So this is why it's quite extensively covered by about 13 analysts. However, the stock is too early in its growth phase for us to consider it to be a suitable investment for our members. And that's because the company generates no profits and is currently in a marginal financial health position due to the lack of its sufficient cash flows. Its balance sheet appears satisfactory because the company does not have all that much debt, and it has a fair amount of funding from recent capital raisings.
Yeah, with marginal financial health comes significant risks. And this was evident during the week when the company released its trading update and announced that it will be lifting expenses and its capital spending, and that's due to supply chain disruptions. And this, of course, could potentially lead to further capital raisings this year. In fact, looking throughout history, you can see that the company has been raising capital every year since listing.
Yeah, it follows a fairly familiar trend, doesn't it, Kien? And the update led to a fairly significant decline in its share price, falling some 22% over the day and fell again the next. In fact, the chart for its share price over the long term does demonstrate how financially unhealthy companies and speculative stocks can trade. You can see here that they rose to over $20 during that speculative mania following COVID, only to crash and burn in recent months as markets have sold off significantly. So given that the stock is trading at a significant discount to valuation, a few investors may be wondering whether or not the stock is presenting as either a value trap or an opportunity.
Yes, Matt, we believe the risks for this stock remain quite elevated, and we don't think this represents an opportunity at all. In fact, on top of its poor financial health standing and constant capital injections from shareholders, which is quite dilutive to the negative profits that it's generating, the level of short interest has increased to over 10%. In addition, the CEO and directors have sold down large parcels of stock this year as well. And for those interested in this space, though, you can, of course, look for other financially healthy businesses by searching for, say, cloud under the business description field using our Stock Doctor filter tool. Many stocks are now trading at significant discounts to consensus valuation. So, Matt, the question this week is, what are the drawbacks in using valuation metrics alone? Firstly, you can find the consensus valuation or price target of a stock under Golden Rule 5, but this figure is the median of the total analyst estimates that cover this stock. But note, of course, that a lack of analyst coverage here, say 3 or less, can add to the uncertainty around the valuation metric.
But these estimates are subjective and based on future assumptions, including cash flows and interest rates. It's quite difficult enough to predict cash flows on a 1-year look-ahead basis, let alone 10 or 20 years into the future. And with the increasing economic uncertainty and rising interest rates, the present value of future cash flows can change very, very quickly.
Yeah, that's right, Matt. But when a non-star stock is trading at a significant discount to valuation, it often implies that there are heightened risks attached, which could lead to further earnings downgrades or share price declines down the track. And this is also true for income stocks that display a dividend yield that looks too good to be true. Often this concept is referred to as a value or yield trap, and usually occurs with companies in poor financial health or have no profits or strong negative earnings revisions.
And you'll find that the consensus share price targets tend to follow share price movements rather than predict where prices are likely going to go. You'll also find that value traps usually occur in tandem with rising short levels of interest or direct selling. However, for star stocks, a significant discount to consensus price target could imply opportunity. But you've got to familiarise yourself with all of the active risks and fully assess metrics like earnings revisions and the rise in short interest. Stocks that have been sold down significantly but have stable earnings trends could help you with more conviction in the opportunity. Similarly, great quality companies can trade at a premium to valuation for an extended amount of time. They could have, they tend to have high PEs due to their strong market position, quality metrics, and growth prospects. Hence, you should not discount a quality stock entirely if it appears expensive.
Yeah, some wise words there, Matt. So rather than invest using valuation blindly, it's best to use it in combination with other information and understand why a stock is trading at a discount or premium. As Benjamin Graham, who was the mentor to Warren Buffett, he observed that the greatest losses resulted not from buying quality at a high price, but from buying low quality stocks quite cheaply. That's all we have time for today. Matt, thanks for your contributions again.
My pleasure to be joining you. Thanks for having me again.
And let's hope the AGM season and the US reporting season will continue to deliver positive outcomes, especially for our star stocks and the stocks in our funds. In the meantime, for those who have any queries on stocks or the market, you can sign up to our Lincoln Live sessions on Monday, where we answer your questions and also help you navigate through this market uncertainty. To summarize this video, now corporate earnings remain quite resilient outside of resources. In fact, the banks are doing quite well in this environment of rising interest rates with low bad debts. Use the AGM to look for oversold opportunities, but of course, be wary of those value or dividend traps. Take care and have a happy, healthy, and prosperous week, everyone.